Hello, everyone, and welcome to this webinar in conversation with FINTRAIL, Rethinking Your Risk Assessment, where we are delighted to be joined by Melissa Sutherland of EverC. So FINTRAIL EverC discussion on risk assessments. Melissa, thank you very much for joining us.
Thanks for having me. It's amazing.
So today we're going to take you on a journey of the risk assessment, touching on areas such as this is not the traditional threat. This is not your parents' threat landscape. This is a new, constantly changing and evolving world. How do you respond? How do you make sure that your risk assessments are responding in time to the deluge of new information, new emerging risks, new regulatory requirements? And at the same time, how do you take advantage of new technological abilities to counter that? What you need to know for your firm, why the regulatory guidance is sometimes so vague and unsatisfying. The reason being there is no one size fits all for risk assessments, as with so many other things in financial crime. So how do you work out what is most appropriate for your institution? And how can you get creative in incorporating new possibilities in terms of technology and data and new methodologies into designing and maintaining your risk assessment workflows? I think that pretty much sets the scene. Melissa, is there anything to add on that?
Absolutely not. let me introduce these awesome panelists and we'll get right to it. I think we have some really great content to cover today. So on our call with us, we have Rob Evans, and I'm going to do the speaker no and read from my screen. Rob is the co-founder and CEO of FINTRAIL, a leading authority on innovative financial crime compliance. Rob, thanks for joining. Maya Braine. Maya is a managing director and head of insights at FINTRAIL and leads FINTRAIL's thought leadership and research. Maya, it's been awesome to plan this session with you. Thank you so much. As Maya said, I am Melissa Sutherland. I am the head of industry engagement at EverC and a thought leader in the payments compliance landscape. I've been in payments for a very long time, and I'm very excited for today's discussion. We'll kick it off. Rob, if you wouldn't mind, give the audience an overview of who you are and how you fit into the compliance ecosystem.
Hey everyone, and thanks for asking me along. Where do I fit in? That's a really good question. I've probably been asking myself that for the last 5 or 6 years. But as a consultant, well, two things. Firstly, leading the FINTRAIL business for the last 5 or 6 years. I've seen and worked with a lot of innovative financial services firms who are looking to apply risk assessment concepts, and I mean that in its broadest sense. I think we're going to dive into that a bit today, looking to apply risk assessment concepts in new and different ways. So I've seen that evolve. I've seen what works, what doesn't. So hopefully going to share some interesting thoughts on that today.
Awesome. Thank you. Maya, same question. Quick overview of who you are and how you fit in the compliance ecosystem.
So I am a managing director at FINTRAIL. So I work with our clients on a wide range of financial crime compliance projects, including risk assessments in various guises. So enterprise-wide risk assessments, designing customer risk assessment methodologies. And I also lead our thought leadership and insights work. And as Rob said, we work particularly with innovative, digital first, if you want, financial services firms. But I previously worked at a couple of major global banking groups, specifically heading teams working on either high-risk jurisdictions, specifically the Middle East, or high-risk sectors, so correspondent banking, fintechs, global corporates, etc. So both areas where a really good understanding of the risks is absolutely essential. But having seen that traditional framework for how to do that, and then moving into more of the fintech digital space and seeing alternative approaches to how you understand and assess your risks. And Melissa, let me flip the question back to you.
Awesome. Thanks for the detail. I especially like the position that you come from, traditional and then emerging. And I think that's we're going to have a lot of fun talking about that today. So I head up our industry engagement team at EverC, and we provide immediate and ongoing merchant risk intelligence. We do that using technology, a blended approach of technology and human analytics. We do our work for folks in the payments ecosystem, so traditional banking channels, payment providers, marketplaces, MSBs, BNPLs, anybody that's outside of the traditional bank relationship. So we bring in our conversation today, we're going to knit in the narrative of it's not your traditional risk assessment, because risk assessments and payments are vastly different than they are in a banking traditionally defined channel. My career has been in payments, compliance, risk fraud, underwriting, all the easy areas. Hyper focused on disruption of illicit actors. And again, I can't thank you enough for putting this together. I think we're going to have a really good chat today. I think we'll jump right into it. And I will tell the audience, we have a chat feature. If you want to lob a question into the panel, please feel free. We want to make this as interactive and useful for you. But to kick us off, let's level set. Rob, I'm going to come to you first. Let's go ahead and define, and I don't want a classical definition. I want a usable definition. Let's go ahead and define a risk assessment. Let's start here.
Well, firstly, I think risk assessments is a term that gets used in all sorts of industries. So compliance, financial crime prevention is just one of those industries that uses this concept of risk assessment. So in essence, it's about understanding what the potential is for harm to your organization and how that's going to be conducted against you. So it's slightly different to threat. So without getting into semantics, you need to understand the threats that you face as a business. So for example, a money launderer doing certain type of typology on your platform, you need to understand that threat actor to do a risk assessment properly. But ultimately, in the context of financial crime prevention, it's about understanding how your product, platform, whatever it is that you're offering, how that might be exploited by those threat actors for harm. And I think the important thing for us to recognize, it's about some sort of harm occurring. If there isn't something that's going to occur, i.e. there's not going to be an impact in it, then the risk doesn't really exist. So it's about understanding that. It's about trying to understand how that applies to your product or offering, and then what you can do to mitigate it going forward. So it's a way for you to conceptualize it all, understand it, and then identify a plan and a mitigation measure going forward in very simplistic terms. But like I say, it's a really broad term. There's lots of definitions that are used in different contexts. In this conversation today, we're probably going to focus on a few areas around customer risk. I would think will come up a fair bit, and that's focusing on how the customer may perpetrate harm against your business or platform. But we'll probably talk about other broader concepts around things like enterprise-wide, country risk assessment, that kind of thing as well.
Awesome, thank you for that. Maya, you want to bolt on your interpretation of the risk assessment?
I think that's a really good overview from Rob. I'm just trying to think what I can usefully add to that. So yeah, as Rob said, it's just initially identifying the risks that you potentially face and then assessing them is the second part. So working out which ones, two things, which are more likely to occur. So which ones are more relevant risks for your business, and then what is the impact if they do occur? And then as a result of those two things, working out the purpose of doing this, right, is where you're then going to apply more resources. So this all falls under the banner of taking a risk-based approach, which is what international guidance with FATF and national regulations call for. So the idea being that off the back of this, you decide we're going to concentrate our efforts on these risks because either they're more likely to happen or they will have more of an impact if they do. And the corollary to that, which I think is the bit that gets people nervous, is we will therefore devote less effort to these areas, either because they're less likely to happen or because they're not going to cause as much harm if they do. So the risk assessment then essentially guides everything else you do in your financial crime program because it's dictating where you're focusing your efforts and concentrating your resources.
Awesome. And I think that's a really interesting call out of it's the risk assessment is not an end all be all. It's not an if this, not on list, don't do any of these. It's a declaration. And in the payments world, looking at a risk assessment, it's different than in the banking ecosystem, obviously, because what you're laddering up to is the bank standards and guidance. But you're in a payments ecosystem, so it's not so much the cash-intensive money movement, terrorist financing, one-to-one relationship. So the risk assessment for the payments folks is more of a declaration of the merchant types that could create greater rigor and risk in your environment. So you have to have greater rigor on these merchant types. So it becomes an interesting declaration of risk And then these are the appropriate controls, and that's going to be your underwriting policy and your risk policy, and then the measurement piece of that. So it's a really interesting dynamic between what the traditional ecosystem that was set up a long time ago to fight one set of problems versus the payments fintech landscape that they're fighting. But let's pause for a second and think about the overall hesitation and concern in the risk assessment. There is a tremendous, I know in the payments ecosystem, which is where my focus has always been, coming into a risk assessment was always one of the worst things, the worst time of year to have that debate. Nobody wanted to have it. It was fraught with peril. Everybody was nervous. What if we put something on here we shouldn't put on, and the auditor comes in? Why do you think there's so much hesitation in this entire workflow?
The first thing I would say is, I think you perfectly highlighted one of the issues, that it's once a year exercise. So I think we have to be realistic that many firms will look at risk assessment models or risk assessments in the broadest sense around enterprise-wide risk assessments, that kind of thing. They will do it periodically, and that needs to be scheduled because of the nature of that exercise. It can be resource intensive. But I think the fact that people are doing it in that way has been one of the underlying issues, because things evolve so quickly. You know, you look at the clients that we've been working with over the last 5 or 6 years, the business changes monthly almost. Certainly 6 months is a long window in the life of a rapidly scaling or growing business. And I think a lot can change. So it can become irrelevant what you did 6 months ago very quickly, and that can catch you out. So certainly something that we have seen is that nervousness is about the periodic nature of it, but also some of the data points that we as practitioners also recognize have value to be considered in different types of risk assessment scenarios, come with the potential for including things like bias and challenge. So people get nervous about whether they should be considering those factors as well. So I think ultimately it's a task that we need to evolve how we think about it. And I think technology plays a role in being able to keep a dynamic risk assessment process. And in rapidly scaling firms, payments being one area, that needs to be probably a little bit more intrinsic to how the business is growing and scaling.
Yeah. Fantastic. Maya, do you want to bolt on?
Yeah, I think the point about it being a periodic exercise, and it becomes this very, very labor intensive, difficult exercise. And also because I think it's this sense that, like, as new risks are identified, new threats emerge, it gets a feeling of like they just seem to expand. You never downgrade anything. You never get to take things off. You just add more and more risks that you've identified until the whole thing ends up really quite large and unmanageable. And so finding a way to update it, as Rob said, on a more periodic basis, so it's not that you review it after 6 months and go, okay, we need to add on a bunch more stuff and make this an even more imposing exercise. And also that you stick to that principle of adopting a risk-based approach. Like, as I mentioned, I think people can be nervous about saying, okay, we've identified these new areas which are clearly an emerging risk, like the risk of this new fraud typology that we have definitely seen evolving over the last few months. This is a real emerging risk we need to devote effort to. The consequence of that is we're going to take resource from somewhere else. That's what a risk-based approach is supposed to involve to some extent, is to say, if this is not really a threat anymore, or we've reassessed it and we no longer think this is as much of a threat, we can redirect the resources. But people are very nervous of doing that because they're scared that if they do that and then they are hit by an incident relating to that other typology, that they're then going to be held accountable. It's like, well, you said that was low risk, so you said that wasn't a priority anymore, and actually then this money laundering typology did occur, and you are now, you've messed up. But it's the idea that low risk isn't no risk. The fact that you've decided that some things are high risk, some things are low risk, it doesn't mean that nothing bad is going to happen in relation to those low risk areas. It's just on the balance of probability and impact, you were focusing resources somewhere else where you believed it was more necessary and would have more of an impact. And that is reflected in the guidance and the regulatory language, but it is something that understandably, I think people get nervous around. And so for that reason, they add things and they just add more risks and they add more high risks, but don't get as good at making sure that they are not just adding resourcing requirements, but redirecting them, reprioritizing them.
Let's double. Oh no, please.
Sorry, I was just gonna add. Sorry, Melissa.
No,
is that check and challenge process is actually really interesting. I've seen it done once really well, where someone's role in that risk assessment process was to check and challenge the addition without the subtraction of things. And what I mean by that is they were almost playing the I wouldn't say the bad actor, but they were almost red teaming to say, okay, well, if this is no longer happening or this is changed, should we be taking this off the risk assessment or reducing it? And I think that check and challenge is something that doesn't happen enough, because I think you're right. You can inadvertently always add, but you should genuinely be checking and challenging and evidencing why you can also reduce or remove as well. And using your data as part of that is super, super important. So a key takeaway for people is the check and challenge process around risk assessment. Super important, because ultimately it means that you can remove, reduce, and be proportionate with what you're putting on there as well.
And Rob, you touched on actually what I was going to double click on with Maya is the idea of the check and challenge, and that there is absolutely nothing wrong with de-risking something off the assessment, deprioritizing it, or even excluding it altogether if it's gone, if it's no longer a threat in your environment. That's okay. And would you say a best practice is, as long as you have documented the steps that you went through to do that, bolt that into your archives, then everything is fine. And if a scenario comes up, is it typically, it's not going to be the exact same typology. So it's not a gadzooks, I've got you, you made a mistake, right? There is an understanding. There's a cooperation between events, best practices, a mitigation plan, and then if the case scenario and one of the regulators comes in, it's not a I got you moment, is it?
No.
Yeah, regulators are not supposed to have that gotcha attitude, and they don't in practice. They're not looking to find these things that they can point a finger at and be like, oh, you took this off your risk assessment and then this attack happened 6 months later. And as you said, as long as you can document it, if you have got it written down and documented and explained why you have made whatever decisions you have, as long as that's reasonable and you can back that up, that should address any of the questions the regulators might have. And particularly if you've got some kind of data to back it up, if you can say, we have had no transaction monitoring alerts, true positives that have related to this, we have filed no SARs on this, we have not seen this activity, that's why we decided to deprioritize it. Really, there's nothing the regulator's going to say about that.
Outstanding. I think thematically, pulling that notion of a regulator is not out to get us. Yeah. A regulator is here to stress test us to make sure that the worst case scenario doesn't happen to us. That's a really important. We have a question. I'm going to read it really quickly. This is open to both. Is limited experience with truly understanding the threat a common issue with the risk assessment nervousness?
Great question. Yes. So interestingly, prior to moving into the financial crime space, I worked in sort of from an intelligence background, government intelligence and military intelligence background. And the thing that we got drummed into is through those years was you need to understand the threat and the threat actors to be able to form a proper risk assessment. I totally think that is something that undermines to some degree the confidence in the sector to adopt properly dynamic risk assessment, because without that level of understanding, and I think you saw it in big banking a few years ago, the evolution of financial intelligence unit and the use of financial intelligence to better inform risk assessment, I think became really important. So I think we've taken steps in the right direction, but not every organization has that fundamental capability, and that's completely fine because it's probably not proportionate. But understanding how the typologies surface, what you're seeing in industry, what your peers are seeing in the typologies they're exposed to, how merchants are used on a payment platform, using that intelligence to inform your understanding of the threat is super important, because if you can bake that into your risk assessment, that will give you confidence to take those decisions and move forward.
Yeah,
that's my opinion.
That's why it's really important to reassess your methodology or your model. So not just like every 6 months, cast an eye over it, make some changes. But if you are a scaling company or a company that's changing rapidly, you will have so much more understanding of the threats that you face 6 months down the line or in a year's time. You will have learned so much in that environment that you can then use to make more confident decisions and to make your risk assessment more robust. So if you stick with the model that you devised at the beginning, which may have like defaulted to putting everything as slightly higher risk because that felt safer, if you don't challenge that once you have gained more experience and also have more data and more actual like facts as to what the risks actually are that you're facing, you can reassess that. You've got so much more to draw on further down the line.
Fantastic. Awesome question. I appreciate that. Please feel free to use the question box. The panelists are happy to take ad-libbed questions relevant and close to the topic. Feel free to stray a little bit. What are your thoughts on in the risk assessment process, the design of it, kind of laddering back up to the question that was just asked, teasing out into the ecosystem, and I'm thinking from a payments perspective in the merchant environment, teasing down from a data perspective into their customer base as threat actors and as potential nefarious actors. Like how broad, when you're defining risk, how broad should folks make it? How wide of a net do they need to cast before it becomes so fuzzy that it's useless and you're just inundating yourself with stuff that you can't do anything with? That's for either.
Happy to go. What do you want to go, Mark? I think you hit the nail on the head, which is you do need to be a little sensible about how broad you go in the data points and categorization that you utilize, because actually, and you need some consistency to that, especially if you're looking at benchmarking evolution of risk against, let's say, in the payment space. You need to be able to use relatively consistent data points through a period of time to enable you to form that evaluation and justify some of the decisions you make. So thinking carefully about those data points is really important. Does it mean you shouldn't be looking at using much wider data sets that's available nowadays than maybe we used to have historically? 100% yes, because some of those new evolving data points around device ID, that kind of thing that's evolved over the last few years, yeah, there are certain challenges with it about being spoofed and things like that. But I mean, in the broadest sense, there are new data points that we should be using. It's no longer just about what country is this person from. I think that ultimately we should be a bit more creative in what we're doing, but it cannot become so unwieldy that you can't keep up with it. The most effective risk assessment is going to be one that is maintained on a very regular basis with consistent quality data, and it's the quality that I think is important.
Maya, anything to add on that?
No, I think that makes sense. And obviously, this is always the cop-out answer with financial crime questions, like it is a balance. But it does make a lot more sense if your major threat is fraud, like diving into that in more detail, teasing out more specific typologies, working out things like device IDs, etc., things you can use to tackle that in a lot more detail, rather than diving into a bunch of typologies for bribery and corruption, which is not relevant. Again, this is the risk-based approach. You've worked out which risk area is more of a priority for you, and it makes more sense to get more granular looking at that.
I don't think it's a cop-out. I think you're absolutely correct that it's a moment of time measured over a period of time based on what you know to be true in the environment and what your expectations are. The deviations are what drive the models, not the consistent normal behavior, unless it's out of band for the merchant that you're looking at. It's such a fascinating use case when you start to overlay the new technology advancements and the access to these interesting data points that you start to tease out, where in the origination story of e-commerce and overlaying a risk model on top of it, it was very simplistic. Country of origin, very scary countries. Everybody in that country, therefore, is very scary, which results in unmanageable alerts coming into your environment, which then criminal actors, as we all know, test, audit, measure, and pivot within 24 hours. So this evolution and this adoption of technology is really interesting. And I think, Maya, this question is for you. When you think about your from-to journey from traditional banking over into the fintech space, we know that the stereotype of banks not really pivoting quickly to adopt a lot of technology is true. We know that fintech is way out in front of it, trying to test, audit, and create whatever they can to keep themselves safe. Are you seeing banks now recognizing more and pivoting faster in the technology space to protect themselves, or is that still that hesitancy to get in there?
I think the hesitancy might have gone. I think the argument that they need to do it has been won and everyone agrees. I think it often just comes down to the practicalities of how vast the exercises become, and you need to involve so many different teams. You've got so much data and so many different things that you in theory need to bring into these kind of exercises, and it's all fragmented, and it's more the practicalities of how you make those changes and how you implement them rather than the hesitancy around doing it. So the banks, I think, are learning from what the fintechs have been doing, and can want to adopt a similar approach. But I think there are just practical reasons why they're going to continue to lag behind. It's just, it's some sort of oil tanker metaphor here, how much harder it is to change direction and pivot when you're moving something that big.
Fantastic. Yeah, it's interesting. It's a thought I had earlier as you were talking, is the idea of the creation of the risk assessment itself, the policy, the designation of the areas, but then the implementation controls mechanism, the people out on the front line fighting the fight and making sure that the ecosystem is protected, regardless of what the ecosystem defines itself as. And perhaps the hesitancy and the problem is the distance between those two groups. They have a wildly different view, a different lens of the world.
Yeah, I think in sort of the classic compliance terminology of first, second line of defense type concepts, we often will see the risk assessment work stream sit in the second line of defense side. And actually, in many cases, it's the people on the front line, the classic first line of defense in the business, who probably have some of the best insights to bring to bear on the risk assessment process, whether that be customer risk assessment models or whatever it is you're working on. Making sure there's that engagement between the business teams and those doing the risk work and the compliance work is super important, especially in this risk assessment pillar, because without that, you're going to get a very skewed perspective as to what is going on, what isn't, and what the risks might be. And that is actually sometimes what can go quite badly wrong as well.
Fantastic. No, please, Maya.
Just going to add a point. Look, one thing with understanding what risks look like is because they are different for every firm, obviously. So one of the ways that you can potentially spot actors that may pose a risk is what is anomalous, and that is going to vary hugely from firm to firm. So the people that have the most exposure to what normal business looks like, so whether that's relationship management or control, people working on controls within the front line who see a lot more of the day-to-day activity, are going to be better placed to work out, okay, this is unusual, this looks flawless, this is potentially something that we could use as a risk indicator, because they see more of the normal activity, whereas by their nature, the second line focus on the risks and the unusual things and the threats, and not like this is what normal customer behavior looks like. They, by the nature of their roles, don't have as much exposure to that, which is really, really useful insights if you can find a way to capture it. And it's the opposite of the problem of our firms sometimes hamstrung in their assessments because they don't have the experience and the knowledge of all the different risks. Because actually there's so much knowledge within a larger institution. It's just spread across so many different people.
Which is a fantastic point, and this speaks directly to the notion of the culture of compliance from the top. Everybody in your organization is a member of the compliance team, regardless of what their day job is. So if everybody is operating from the premise of, I am here to keep my organization safe and perform my function, I'm the accountant, I'm the settlement clerk, I am the bank opener, whatever your job is, you're always protect the ecosystem. And let's be very honest, criminals, and I wish they would do this, it would make all of our jobs so much easier, don't show up and present themselves as, hi, I'm a drug lord, or hello, I'm a West African crime lord, I'm here to do terrible things in your environment. It doesn't happen. They come in masquerading as something completely benign. But there's characteristics that your frontline service agents will know, well, that's not a typical user behavior, that's strange.
Yeah, it's not the 101 of red flags of, it's it's in these high risk jurisdictions or it's a high risk industry or whatever, like, everybody knows to avoid those red flags. So sometimes it's not even something you can say, like, I don't know why this is a red flag, but it's weird.
Yep.
Normal customers don't do this. So I don't know why this is necessarily an indicator of risk, but I can only see it in these few cases, and the transactions also look weird. So yeah, sometimes it's, yeah, as you say, the criminals are not stupid. They don't show up as whatever your textbook, these are your high risk indicators. They know to avoid those. So you have to look for what clues they do give.
One of the questions I've always found probably most powerful when talking to, and this specifically applies to early stage companies as they're getting going, is to talk to the CEO or the key founders as to what do they see their classic user, what do they see that atypical user looking like? And I don't mean necessarily in personality traits, but they know what their product is or what they're trying to achieve in developing the new product. So how do they expect their users to apply it? So if it's green investing, what does that look like, and how do you apply that to your risk profile and risk profiling of your customer base, for example, is super powerful. Because a lot of people will say, well, our company is very early stage. How do we actually form an appropriate, in this case, customer risk assessment model or customer risk profiling generally? Well, actually, by understanding how you would expect your product to be used in the first place enables you to move that forward. And in many cases, the small founding teams are the best placed people to do that. So you magnify that across to a massive global organization. The business people who are selling the products are the ones that should really understand what an atypical user looks like of that product. So then detecting or identifying deviations from that from a risk profiling perspective is super powerful.
A fantastic comment. And I think that ties back into the opening comment from Maya, that this is not your parents' risk assessment. It's not a moment in time, it's an evolution of time. And the use case of how the consumer is using your product, I don't think that was something 20 years ago that would have dawned on people to start measuring what normal, typical use cases look like, and then following a deviation from that. I don't think the technology was at a place where it is now. And it's certainly in the fintech space, they can measure mouse clicks, eye movements, expected time on page, area of page sitting in, which is just a phenomenal way to measure expected use, anomalous use, which may not necessarily be an indicator of threat, but then you have illicit use. So being able to bucket those leads to scale and safety. We have a question that came in from the audience. I'll throw it out to either. How would you see your AML risk register to align with your risk assessment? I don't know if that's a product. Yeah, I don't know if that's a product or.
More specific. So the risk register is obviously part of the assessment. Like this, the first stage of doing it essentially is to work out your register of risks. If this is part of an enterprise-wide risk assessment or a product one, of defining. This was the first stage I was talking about, like defining the risks, identifying the risks that you are exposed to before the second stage of then assessing them and prioritizing them and checking how your controls map against them. So I guess one thing to be aware of is like reassessing that register is also a key part of all of the updates. You're not just reprioritizing, well, which ones seem to be more of a credible threat, which ones do our controls work better with, is also like actually looking at the register again. And also going back to your point about like, should firms go really broad or should they be more specific? Again, like working out, is this working for what we need it to do? Is it too broad? Do we have far too many risks identified in this registry? And actually we need to hone in on a smaller number, or do we actually think that we're missing things? Are we seeing transaction monitoring alerts? Are we seeing investigations that we're conducting that actually don't seem to map to any of these? And so maybe we need to take a broader look. So it's a component of that overall assessment, but also something that I think you need to be assessing on a regular basis to make sure it's still fit for purpose and aligns with all of the information that you are continuing to gather as your products and your services evolve over time.
Yeah, I think I'd add, so long as I just hopefully I've understood the terminology and the question correctly as well. So forgive me if I haven't, whoever asked it. But I also think the risk register is a really great communication tool, right? that ultimately enables you to articulate where you are to stakeholders. So making sure that that is in a form that people, we all do it. We do it with clients. A lot of this is spreadsheet based. There's new technologies out there now that enable you to do this in a better way, but really thinking about how you articulate the outputs of this risk assessment work and how you then leverage and use it in decision making is so important, because it's pointless doing it. And the one thing the regulator will come after you for, and I have seen this numerous times, is where you're doing a risk assessment process, but you're not doing anything with it. And that is both on a customer side, risk modeling, whatever it might be on that customer side, but also when you're looking at broader enterprise-wide risk assessment work streams. If you don't do something with the outputs of what you're doing, what's the point? And that is something they will come after you for. So if I've understood the question correctly, using the risk register to articulate and communicate that to decision makers, and then making some decisions on the back of it and recording that, is super important.
Outstanding. Yeah, that ties into an area I wanted to touch on, and I think, Rob, you hit on a couple of salient points, but some of the gaps from your lens out in the broader space that you operate in. What are some of the other gaps that you're seeing that could lead to a negative event occurring, and or a regulator not being overly thrilled with the way that you've set up your program?
Do you want me to start on that? I think I've sort of chipped in on one of them already, which is not using it, or the other one is deliberately changing the output for the benefit. So benefit, or a benefit from a business perspective. So what I mean by that is, despite what the data tells you, manipulating the output so it gives you more scope to do what something the business wants to do. So having that robust methodology and governance and everything around how you use the risk assessment is super important, because if you do that and somebody catches on to it, that's definitely opening you up for some big questions. The other thing, and I think I may be jumping ahead slightly, but is fear. And what I mean by that is, one trend that we discussed when we were prepping for this was this really interesting phenomenon that you're now seeing people getting nervous about using certain data points because they don't want to build in bias or the perception of bias into risk assessment works, whether again that be risk profiling and that kind of thing. And actually that has almost gone too far now, where some of these approaches are proving to be ineffective because people have allowed the fear of applying bias to derail the solid intention of using the right data points to genuinely inform on financial crime risk. And I suppose the caveat to that is that we at FINTRAIL have always tried to be an advocate for removing bias. But I think what we mean here is, and something for people to reflect on, is that if you can check and challenge, it comes back to check and challenge about the fact that your decisions are not based on a biased view, i.e. you've not let racism or whatever it might be form a bias on a decision around a data point. It is fine to include that if the data underpins it, whether that feels, you've just got to have that challenge process. So, sorry, very long-winded answer to this fact that I think fear is starting to play a factor.
I think you touched on such a relevant point about the fear and the bias concerns. Rightfully so. We all should have bias concerns about the models that we're building. Do you think having a robust look-back mechanism for all of your events and determining what the commonalities are and teasing out the commonalities, then building your model, is the right approach? And if yes, what do you think of the cadence of such a look-back approach should be to keep the modeling fresh? Maya or Rob on that one.
I think definitely, yeah, having a look back process is really vital, because I think that was going to be one of the things I was going to say in like terms of the gaps. It's like that the outputs or the results of your risk assessment aren't questioned or tested, that you don't actually look at the actual activity that you're seeing, or the SARS that you're filing, the actual suspicious or illicit activity that you're identifying and saying, well, was that reflected in our risk assessment? Did we pick this up correctly? So anything that, so questioning the outputs, and making sure that feeds back into how you identify risk is, in a way, the soundest way to do it. And then to Rob's point, that way you can also justify your decisions. You're saying, well, this isn't based on some assumption that these countries are higher risk or these industries are higher risk. It's like, that's what this is based on. This is what we have actually seen, is that these sectors are involved in a disproportionately high number of cases of illicit activity that we've identified. And that will also challenge your assumptions as well. If you're assuming that it's high-risk sectors are gaming and adult entertainment and cash-intensive businesses, actually, maybe it isn't. You know, the common one that everyone cites is like charities and non-profits, which are automatically assumed to be high risk, but quite a lot of the time they're not. They are, you know, that maybe was a really prominent area of risk 10 years ago, when more terrorist organizations, for instance, were using them because they were not as highlighted as an area of risk. It was a relatively it was an easy way for terrorists to move money around, but then the risk was highlighted. Everyone elevated charities and NPOs to high risk, and it no longer made sense for terrorist organizations to do that, so they moved to something else. So if you're using your actual data, then you remove assumptions and historic information like that, and reflect on what industries, what sectors, what company types are actually happening now. And in terms of the cadence, it's another difficult one to answer without a fudge, which is that it depends on the institution. So it's partly how, you know, if it's a relatively new company, it's evolving, it's scaling quite rapidly, you would maybe want more of a regular cadence because things are going to change more quickly. If you've been running for a longer period of time, your activity, your customer base, etc., is more established, it's not changing as much, you maybe would be able to do this at longer intervals because not as much will change in the meantime. It's possibly a question of trial and error, like doing it more frequently, and then if you're not seeing that many changes, you can maybe go to a longer model with longer gaps in between. And it has to be manageable as well. If you say that you're going to do it every 3 months, but you do not have the resources, then don't promise to do that. You're just going to, you know, the regulators will pull you up on that you've said you're going to do this thing, but you're not doing it. So make sure your plans are realistic.
Outstanding. Do it. Commit to it, document it. If you can't and you've overcommitted, adjust, document the adjustment, and continue forward. Let me ask you a question. I'm going to put you on the spot a little bit. I know we didn't discuss this previously, but when setting up your risk assessment, when understanding what your risks are in your ecosystem, do the regulators do a great job at teaching the ecosystem how it's evolving, where the new threat landscapes are? And if yes, where should folks be going to get it? Terrible question, I know. And I know the answer.
Brilliant question. I've got a lot of love for regulators. Now, genuinely, they have a very, very difficult job. And I will probably be the first to sometimes say that they don't do enough. But generally, lots of love for the regulators. However, this is definitely one area where I don't think the guidance has moved forward with industry development. So if you look at some of the guidance still available in the UK for financial institutions regulated by the FCA, but also in the US and other markets, the guidance, in my opinion, is still quite ancient. Is that the right word? No, anyway, old. But it hasn't kept up with the evolution of different risk areas and how that manifests in different forms of financial products. So yes, it's broad, it's principle-based regulation, and that's super useful, but it does leave a lot to be interpreted. So for example, if I could just very quickly, one example, I've certainly heard of cases recently where regulators have been pushing firms, for example, to consider things like employment or salary and account turnover in things like customer risk assessment. Now, I, as somebody who has spent quite a few years looking at risk profiling of people on different fintech products, often would say that using unverified data points like that are volunteered by a customer to risk profile is very challenging, pretty ineffective. but yet the regulators are still towing a underlying tone that they expect things like that to be considered. So it's, I'm not even quite sure what the phrase would be, but regulation by proxy or something like that. Instead of being specific and saying, you must do this, there's an expectation. If you don't, they look at it with a lot of scrutiny. So do I think the guidance needs to evolve? Massively, I do in this area. But I do think we're seeing some dangerous precedents. And I think we commented on some of that last year publicly. I think there's some dangerous precedents in some of the findings recently where the regulators have taken a particular course. But
Maya, you want to add in on that one?
No, I don't think so. I think Rob's exactly right. And I think the guidance often is it's so high level as to not be that helpful. The guidance in the UK, for instance, calls out that there are national risk assessments that you should use. The national risk assessment is so high level that it's not that helpful in designing and implementing your risk assessment, which is partly because of the caveat that it has to be appropriate for your business. So there is a limit to what the regulators can say that is going to be applicable to all of the regulated entities. But at the same time, there could be more specific, so for payments firms, for instance, more applicable guidance for particular sectors or types of regulated entities, or direction to other resources that are more useful. One thing you can sometimes read between the lines is the regulations obviously apply to absolutely all firms, but enforcement actions that are against a comparable company might give you an idea of what the regulators expect. So to Rob's point, they may have slightly impractical or outdated expectations, but that can sometimes give you a sense of, okay, this is a comparable firm, this is what it was doing, and the regulators did not think that was sufficient. I can use that as more of a useful benchmark than the actual regulations themselves that apply to absolutely everybody and therefore don't tell me very much.
Awesome comment. And I know we're coming up on time, and I could spend the rest of the day chatting with both of you on this topic. It's such an important topic. Closing comments in a moment, but I would love for you to both touch on really quick impacts of getting it wrong when you do this poorly and when you don't have a good customer risk ranking. And outside of the enforcement, what are some of the other pitfalls that people need to be really cognizant of when they go into this?
I think partly the point about the risk-based approach is if you haven't identified where your actual risk areas are, you're potentially misdirecting resources. So if you consider too many low-risk customers to be high risk, you're then spreading yourself too thin. You're not actually concentrating on your areas of risk. Conversely, obviously, if you don't identify actual high risks, you're not going to be giving them enough scrutiny. So it all dilutes the effectiveness of what you're doing. And I suppose the other, to Rob's point about preventing bias, you can also end up being unfairly and unnecessarily detrimental to customers. If you're actually saying that certain customers are higher risk and therefore should be subject to EDD or should have their transactions more closely monitored, if that's actually based on a real risk, then that makes sense. That's what you need to do. But if it's based on assumptions or historic information and it's not actually true, then you are disadvantaging customers to no actual to no good effect. And those customers, from a business point of view, you risk losing them. But from their perspective as well, they receive worse customer services. They can't access as many services, products, etc. And it's not risk-based. It just ends up being detrimental with no underlying risk justification.
Awesome. So I will ask for a closing statement from both of you in one moment. I have a question that just popped into the chat box. What is the best way to document your risk assessment? Is it a spreadsheet for tracking purposes? And should you use the RAG ratings, RAG? Is there a template or guidance we could refer to when creating a risk assessment? Awesome question.
Yeah, cool. So on guidance and templates, there certainly will be some guidance available in the different jurisdictions from regulators of also trade bodies. I think there's probably a fair bit on our website. And I think actually one of the outputs of this is we're going to circulate some stuff to everyone afterwards, some checklists and some guidance that people might find useful. So more to come from FINTRAIL side on that as well. So please keep a lookout for that. I think ultimately, don't let the fear of getting it wrong inhibit you trying to develop a good process. Just be robust. I always suggest having a fully articulated methodology statement. So what methodology are you applying and how do the calculations work and that kind of thing. That is super important because it enables you to tell the story to whoever is asking the questions. So make sure you have a very clear methodology articulated. You can evolve that as you want, but write that down. As far as spreadsheets, there's some tools available now. I've seen people use things like Monday and all sorts of other sort of project management tools to help better physically capture the outputs of the risk assessment process and articulate it in a way people can consume better. And there are some products being developed that I think will move that forward quite substantially. But I think ultimately, yeah, people still use spreadsheets. There's nothing wrong with that, but making sure you've articulated the math behind it in the clear methodology statement. And then once that's locked down, make sure you have robust governance in place. And I know that's a boring word, but make sure you have robust governance in place. So if things change or evolve, like you said, Melissa, earlier on, you note it down and keep a record of it. So that ultimately, if things change, you can describe why.
Outstanding. Maya, do you want to go to closing, or do you want to, you can feel free to bolt onto that question, or we can start moving towards wrap up.
Go to closing. I think, yeah, Rob answered that one. Briefly. I can probably segue into a closing thought from that, though, because I think one thing with using spreadsheets, using the other tools, is it's about what's proportionate for your business. So how complex is the threat landscape which you are facing based on your customer base, your product offering, etc. So a simple spreadsheet might work absolutely fine depending on the complexities of your company, or you may need something more robust. There may be technology, software solutions, etc. that you can use, and it's just about what's proportionate. And I suppose one of my takeaways would be that applies to all the elements of this, really. So how you can make risk assessment processes almost infinitely complicated, like having seen how a major global bank addresses the country risk part of this. So one part of the risk assessment, which involved a team of consultants working for 9 months on devising methodology for assessing country risk, and then having several meetings involving people from all the different business lines and risk functions to identify the country risk appropriate for all the different business products. Like, you can make this almost infinitely complicated. Most of the time, that's not going to be necessary. So working out what data you have that you can actually realistically use, how often you can review and refresh this, what tools and software methodologies you can use to conduct this process. It has to be realistic. It has to be something that you can actually implement, and it needs to be proportionate to the risks that you face. So I think that is one, that would be my takeaway for this.
Outstanding. I think partnering intelligently, questioning infinitely why you're doing something is not appreciated enough across all channels that are in scope for a risk assessment. I met a consultant a million years ago who came in and was doing an audit on a payments firm. And they were great. They were buttoned up. They had policies. Everything was fantastic. And the consultant came in and said very few words, except, why do you do this? Why do you do this? To what end? What's the purpose? And it became very clear that the documentation was absolutely stellar, but the agents underneath that really didn't understand why they were doing the functions. They knew they had to do the function, and this is the prescriptive way to do the function, but didn't understand the underlying why. And I think there's a misconception that the policy is enough, the results are great, maybe you even tested it, but if your folks in your company don't know why they're doing these functions, then it's kind of, you're missing a lot of, for busy work, you're missing a lot of the cool stuff that you should be offboarding or should be highlighting and escalating within your environment. We're up on 55, so I think we've blown past. I think we were supposed to end at 45. Any further comments or questions from the audience? Feel free to drop them in now. 10 seconds each, wrap it up. This has been amazing from my part. Thank you so much for letting me hang out with you guys for this hour. You're doing fantastic work and absolutely keeping the world safe. So thank you very much for your efforts.
Thank you very much. If anyone does have any, sorry, do you want to? I was just going to say, we can also just bring up a quick poll online whilst, Rob, if you wrap up. So if anyone would like to speak to us about this more, click on the link that's going to come up on the screen now to let us know, and then we can carry on the conversation. Or if you have additional questions we haven't had time to answer, we can do that. We can do that offline.
The only thing I was going to add is, yeah, it's a hugely dynamic topic. I think we've surfaced some of the interesting points of how things are evolving in this space. And like you said, Maya, it can be extremely complex depending how complicated you want to make it, but it's not something people should be scared of. It's something you're expected to do, and there is help out there ultimately, whether it be us or others that can help. So just reach out if you need it.
Thanks. Fantastic. So yeah, thank you, Rob. Thank you, Melissa, for this really engaging, energetic conversation. It has been great. Thank you, everyone, for attending. We will be sending out some more materials, as Rob mentioned. So hopefully some further guidance, and you have the opportunity to ask us further questions and to pick up on this. We said it's really hard for the regulators to give guidance that applies across all the different firms and entity types. And I guess it's the same with a webinar like this. There's only so much we can cover, but if you want to talk through the specifics for your particular business, we'd be very happy to have that conversation. Yeah, thank you all very much for attending. We hope you found this useful and look forward hopefully to seeing you at another upcoming webinar. Thank you all very much.
Thank you.
Thanks.
Bye now. Bye now.